Hello, I'm Carol Alexander. I'm Professor of Finance at the University of Sussex, visiting professor also at Peking University PHBS Business School. And I'm going to be talking today about hedging Bitcoin options and also modeling their implied volatilities. I also wrote a little piece as a sort of teaser for this session, which I think may have been distributed. I certainly put it out on my LinkedIn channel, so you may want to read that, but there's much more information, of course, in this talk. Now, my slides have hyperlinks to the papers there's two papers that the talk is based on, but also to other papers and other parts of the internet. So let me just show you my website, because after this talk, I'm going to put the slides up there. So this is www.coalexander.com. And if you go to the media tab, that's where I tend to put, I've got a few others to put up there as well, but I'll do that pretty soon. I will put these slides up there so you can use the hyperlinks and see the papers. I'm going to also put links on the papers page as well. One of them has actually already been published, and so you'll be able to see it on the internet. Okay, so let me share my slides. So this is joint work with a PhD student called Arben Imrai at the University of Sussex, and also a colleague at the School of Banking and Finance in UIBE in Beijing, a chap called Jun Deng, and we've written a few papers together actually. So I'll be talking about two papers, one with Arben and one with Jun. I should mention that anything blue is a hyperref. So and I do recommend Nansen.ai reports. There are a couple that are really interesting about the recent attacks that we've seen on various projects in the DeFi, the decentralized finance space. So Bitcoin, we're going to be talking about Bitcoin options, is a purely speculative asset, but its price is a reflection of the entire crypto asset ecosystem, which is a pity, to be honest, because there are other really valuable crypto assets. For example, Ether, which is the currency of the Ethereum blockchain. It's what we call the native token. So it's used for gas, for fuel, for the smart contracts, and like Bitcoin, it's still mined, but soon it will be staked in order to build more of the blockchain. That's how it's produced. And there's some sort of limit. For example, the Bitcoin reward for building a chain halves every 4 years, and so it's not like a fiat currency. You can't just print it. I suppose that gives it some scarcity value, but Bitcoin blockchain is just a sort of toy. It was always intended as such, but nevertheless, it was the first, and so it's become the instrument of speculation, and that's the topic of this talk. Now, recently, the price of Bitcoin went down to about 20,000. I actually predicted it would go down to 10,000 this year. That was in the New Year's round of, what do analysts predict to the price of Bitcoin. But I'm not sure it'll get down that far. We may have seen the worst of the fallout. What happened was there was an attack by traditional finance, and it could also have been centralized finance. It's not clear who is trading what on chain because everything's pseudonymous. It's just a wallet address, and many wallets have been identified. For example, the Nansen blog that I linked to here identifies the owners of many of the wallets. For example, the Celsius wallet was identified involved in the fallout from the Terra Luna stablecoin attack. It spilled over to this staking as a service platform, Lido, which has a sort of money machine with lending services like Celsius, which was used by Three Arrows Capital, that big hedge fund that has just filed for Chapter 15 bankruptcy. Anyway, so I think we've seen most of the fallout now. Whales are holders of very, very large amounts of crypto with the intent of trading. And so Whale Alert and various other websites track the movements of whales, which are pretty good indications of what's going to be happening. And so the Nansen report identified quite possibly large US hedge funds that were involved in Terra Luna and the fallout into the Three Curve Pool and Celsius and Three Arrows. And I liken this to the sort of collateralized debt obligation bonds that we saw that were exported. As you've seen The Big Short, I'm sure many of you have, and the story is that large banks colluded with the rating agencies long enough to keep their senior tranches at A or even AA rated, and then exported them to Europe, whilst they could still get some money for them, at which point everything defaulted and the mortgages in Alabama were no longer able to pay for these CDOs. Anyway, so it wasn't intentional necessarily, but it was an economic bomb. And I think these attacks have had the effect of being something of an economic bomb, possibly by TradFi onto DeFi, and at the moment CeFi, that's centralized finance. These are players that have much more solvency and haven't been affected by this, are trying to bail out a lot of the DeFi institutions. But that's not the topic of this talk. I just thought I'd better mention something on that because it's been happening quite a lot recently. As a result, the open interest on Bitcoin options has fallen. It's been around, you can see in this graph here, which is from the block, about 7.5 billion in total open interest, trading volume around 20 billion. This is just on Bitcoin options, a bit less on Ether options. But the dark navy blue is the Deribit exchange. Now, Deribit had loaned Three Arrows quite a lot so that they could take their bullish positions on crypto options, which were then liquidated, because that's how the clearing works. There's no margin calls. They're just automatically wiped off and liquidated. And then Deribit asked for the repayment of an $80 billion loan that was made to them in order for them to make those trades. So that's why Three Arrows got scuppered. But behind it, we have some pretty big Wall Street traders using the Deribit platform. And market makers and uninformed professional traders are running a very, very risky business. Anybody who's short an option is going to be definitely exposed. So the questions I'm answering in this talk are: how should market makers delta hedge their Bitcoin options positions? And how can we use the dynamics of the implied volatility surface to characterize the net buying pressure, which is the buying pressure minus the selling pressure on Bitcoin options? So a little bit about Deribit. They moved to Panama from the Netherlands in February 2020 to avoid compliance with the European Anti-Money Laundering Directive, as they state on their website. So as a result, Deribit's not required to make any report on suspicious activity, including manipulation. If you look at the blog on my website, you'll see there's quite a few blogs about manipulation, not on options, but on an instrument called a perpetual futures, which is where most of the trading volume is located. Not so much on Deribit, because actually most of the trades on the Deribit perpetual is for hedging. But the speculative trades on Bitcoin perpetuals all across the centralized finance exchanges are leading the price discovery. There's quite a few papers on that, which I'm not talking about today, but if you look at the papers on my website, you'll see them. Anyway, so there's a minimum know your customer process, and clients' identities are only linked to wallet addresses. So they're what we call self-regulated crypto exchanges, and they trade 24/7. They only onboard and offboard crypto, which means that the settlement has to be in crypto, in fact, in Bitcoin for Bitcoin options. So these options are called inverse options because the strikes are in dollars per not the dollar price of Bitcoin, but the settlement is not in dollars, it's in Bitcoin. Anyway, there's another paper coming on that. It's been coming for a while. Hopefully that'll be up on my website soon. About 90% of all the trading volume on Deribit is on expires of 60 days, actually mainly 40 days or less. Is they don't have the standard expires like the CME options do. CME, Bitcoin and Ether options follow very much the model of other CME options, although the trading is longer, it still closes a little bit, whereas these are 24/7. And the CME options are standard type options, so they're settled in dollars. And they issue 1 day, 2 day, 3 day, 1 week, 2 week, 3 week type options. The issuing schedule is it changes over time. And the liquidity is concentrated on out the money options. I'm measuring moneyness just as K over F here, the strike over the perpetual's price. F is the perpetual. And generally speaking, they range between about 0.7 for the deep out of the money puts and 1.3 for deep out of the money calls. This gives you a longer view about the volume of trading on Bitcoin options. So you can see that it was only really in late 2020 when we had a big surge in Bitcoin prices. Then we had this follows the price of Bitcoin more or less. But Deribit has always been the main platform. CME has become the second platform, as you can see more recently. In 2022, it's OKEX is still maintaining a market share, but still it's Deribit. And this is July so far. So what are we looking at? 12 days. So that's less than a third of, more than a third of the month. You can see that the volume of trading is going to be much less than 20 billion, probably more like 10 billion in July. And there we are, Ethereum options. Less traded on Ether options, actually. They call them Ethereum, but Ether is the actual, as I said, the coin or the native token for the Ethereum blockchain. Okay, so let's have a look at implied volatility behavior, first of all. So here is a graph produced by Arbon, very beautifully. The VIX methodology for the S&P volatility index, the fear gauge, okay? And you see the VIX jumping up to 80% when things are pretty bad. In June, for example, with the FOMC announcement of rise in interest rates, the VIX jumped up to 30%. But you can see that the level here is like 80%, 60% is a sort of, wouldn't say equilibrium level, but that's a sort of fairly standard level that has been for some time. This is just from 2020. We started calculating this way back when Arbon started collecting data in his master's course. Anyway, so this is a term structure: 10 days, 20 days, 30 days, 60 days, 90 days, synthetic constant maturity options, and then we apply the VIX methodology. And so we see the term structure swinging between backwardation and contango. So here's a brief period of backwardation. It's longer than it is for S&P options. The VIX hardly ever goes into backwardation at all because of the volatility products, but that's something else. I won't go into details. But during tranquil times, you see the green, the 90-day is above the 10-day. When there are upward jumps in price, here you see the fear index going up during the initial boom in November 2020. So it's quite different to S&P. We don't see volatility jumping up like that when the S&P goes up. Mind you, it doesn't trend as much as Bitcoin, as rapidly as Bitcoin. Okay, just taking a 30-day implied volatility curve view here. So you can see we have the usual sort of downward sloping smile. For example, just recently in May, there was it doesn't look very steep here, but that's because the axis goes all the way up to 200%. This is the outbreak of COVID at the beginning when it was 200%. But in February 2021, we had this upward sloping smile. Quite often there is an upward sloping smile, but more generally, it's much more symmetric than the equity options. It's a little bit more like currency options. I mean, what is Bitcoin? Is it a currency? Is it an equity? Is it certainly not a utility? Anyway, that was the point I made at the beginning. Okay, this is an alternative view which shows how different the Bitcoin implied volatilities are. So this is just a line plot with the red being the calls and the blue being the puts and the black being at the money, which is almost always right at the bottom. So we've almost always got a sort of smirky smile shape here. Okay. Comparing with S&P options, this is just looking at maturities traded. And this is taken from the paper with Jun, which I'm going to be talking about the buying pressures on using very tick level data. So we've divided the maturity into options with expiry within a week, within 7 days, then within 3 weeks, that's 8 to 21 days, and then more than 3 weeks. Compared with the S&P options, we've got the very short term, up to 1 week expires, but then up to 90 days, up to 3 months, because a lot of trading, in fact, most of the trading, you can see 54.33% here in 2020, is on the 8 to 90 days. But you've still got, S&P options traded up to a year ahead, maybe 17%, 15%. We don't have the data for 2021. And it's very different if you look at Bitcoin options. You've got a much more equal distribution here with big concentration now on the very short-term options. That's where a lot of the speculation is happening, the short-term options. And then 30% is in up to 3 weeks, and then another 30% greater than 22 days. Okay, so that's quite different. And also when we look at the moneyness of the options as well. So in this paper, we bucket the options into deep out of the money, out of the money, at the money, in the money, and deep in the money. And we also distinguish between puts and calls, but I'll talk about that later. But this is just the absolute value of the delta using capital delta here for the delta, for the deep, out of the money. And if we look at the trading distribution there, you can see that, for example, 13% of the options are deep out of the money calls in 2021. 13% are deep out of the money puts. And that's quite different from the S&P, although we only have in 2020. In 2020, in Bitcoin options was also fairly equally distributed between deep out of the money calls and deep out of the money puts, whereas many, many more deep out of the money puts. This is the insurance value, of course, of an out of the money, a cheap put on a broad market index, which is pretty well known. When we look at in the money options, again in 2021 or before in 2020, it's the same. It's about 5% of all the trades are in the money or deep in the money, so not very many. And it's the same, about 5% of S&P options are also in the money or deep in the money. Very similar there. So the big difference is really on the out of the money, where you see equal quantities of calls and puts, whether they're deep out of the money or out of the money, but not on S&P options. And of course, the trading volume is far, far greater on S&P options. Okay, so here's the first paper. As I said, these blue things are hyperlinked, so this will take you to the paper if you look on the slides on my coalexander.com on the media tab. You'll see the slides after this talk. So we're looking at robust, i.e. model-free, not dependent on some stochastic volatility model with various jumps. Dynamic delta hedging strategies. So we're just going to use smile-adjusted deltas. In other words, the delta, I'm using a little delta here because it's a different paper. I do prefer actually the little delta, but there we are. So the delta for an option of moneyness M is going to be a sum of the Black-Scholes delta plus some sort of adjustment. And the adjustment will be 0, of course, if it's Black-Scholes. And these various adjustments here depend on the Black-Scholes vega and also on the theta for implied volatility. It's sigma in the other paper. Sorry, they're two different authors, two different sets of notations. So the theta is the slope of the smile at moneyness M here. Theta M is the slope of the smile. And if it's pretty flat, of course, the adjustment is going to be pretty small in these, except for the Hull-White adjustment, which is based on a regression of the P&L of a delta hedge portfolio. I won't go into details about that. It doesn't turn out to be very good either. And then you've got the minimum variance one, which is a full rather than just a partial derivative of the delta that takes into account the correlation between implied volatility and price. And in S&P options, we definitely need to use minimum variance deltas. There's no question about that. The question is, do we need to in Bitcoin options? So these models are either model-free in the sense this SI, scale invariant. There's a paper here that I wrote with another PhD student, Leo Nogueira, published in 2007, which proves that every stochastic or local volatility model that's scale invariant, and it should be scale invariant if you've got an option on a tradable asset, it has to be. So all these, whether you've got double jumps and long-term vols or whatever, it doesn't make any difference because your delta's all the same. The only difference is calibration error. So that's the scale invariant delta, which turns out to be the same as one of Derman's. These are very popular in the industry, the parameterizations of the local volatility depending on the regime. So the sticky strike SS, which doesn't require any adjustment, is when you've got a stable trending market. Sticky tree is when you have a crash market, and the sticky moneyness is a range-bounded market, and they're all slightly different for the implied tree. The sticky tree is the only truly local volatility model which has one tree that you can price all options on. Otherwise, you've got an option that depends on the strike, K, or you have an option that a tree that depends on the moneyness. So as the moneyness of the option changes over time, you have to jump to a different tree to price the option. Anyway, and this is all well known from 20 years ago. I'm sure many of you who are market makers in Bitcoin options will know about these models. So the data covers out-of-the-money calls and puts with constant maturity is just 10, 20, and 30 days because the liquidity in the money options and with longer maturities is not really sufficient to get this very long period that we're looking for. And we're doing rebalancing every 8 hours, also daily or 5-day, depends. You can see the results in the paper. And we measure hedge effectiveness using this, trying to get a small variation of the hedge portfolio. That's obviously where market makers can then make their money on the spreads by reducing their spreads because they're reducing their risks. And then I use variance ratio tests, not standard deviation ratios, but variance ratios, F tests, to see whether we can improve on Black-Scholes in a significant way. We also look at hedging with the right calendar future as well, or looking at the perpetual contract, and the basis is still pretty large on the calendar futures actually. So the options are better hedged using the perpetual contract, and that's very significant, much, much better to use the perpetual. And then the scale invariant, sticky moneyness delta is the only one, not the minimum variance. The scale invariant delta is the only one to beat Black-Scholes consistently and significantly, and not for out-of-the-money options. You might as well use Black-Scholes. But for out-of-the-money puts, we sometimes see efficiency gains exceeding 30%, really, really big efficiency gains from using out-of-the-money puts. And for short-term out-of-the-money calls as well, particularly when you've got an upward sloping vol curve, that's when you'll get a good, better hedge from using the scale invariant adjustment. Okay, now I'm going to talk about, oh, by the way, do post any questions. I'm not sure whether I'm going to see them properly, but if you've got any questions, just post them onto the chat, please. Okay, so this paper, again, there's a link to the paper here. So we're looking at tick level deribit option price data from 2017 onwards. So we chart the efficiency of the market over time, but it's only really from 2020 onwards that we start seeing the market makers operating in the way one would expect. So we can infer which type of traders are dominating the market by relating movements in the implied volatility curve to something called NBP, net buying pressure, which is the delta weighted difference between the buyer initiated here, the BIT, and the seller initiated trading volume. So we look at the number of buyer initiated and seller initiated trades, and for each trade we multiply it by the delta of the option. And we'll do that but in a periodic manner. And the results I'm going to show you here are based on hourly data, but there's a big appendix that looks at robustness to looking at daily or weekly aggregation of these buying pressure metrics. It's not just the net buying pressure we'll look at, we'll also look at volatility pressure and directional pressures as well. We also disaggregate the results by the option maturity and by the trading time zone. So we have 8 hours by UTC, which roughly corresponds to Asian trading, European trading, and US trading. So quite a lot of results. This is table 11. And in these results, you've got just constant, and then you've got some controls here for return. And so this is the coefficient on the return. And this is the coefficient on volume, trading volume. And these are all highly significant, these controls. Well, they are for at-the-money options, actually. But beta 3 identifies vol trades, beta 4 identifies directional trades, and beta 5 identifies the sort of negative autocorrelation that one would expect in implied volatilities, because the market is called the limits to arbitrage hypothesis. If market makers could hedge perfectly, then they could supply an infinite amount. It wouldn't be affected by, you'd have a flat supply curve. But because of the liquidity issues and so forth, and imperfect hedging, the supply curve actually slopes upwards. So when you've got a big net buying pressure, that's going to increase at the money volatility, but then market makers will rebalance their inventory. They would rebalance that buying pressure and reduce it, which will then reduce the volatility. So that's why we see this negative autocorrelation term here, which is very, very significant. This is just using 2021 data. These results are very robust to different years from 2019 onwards. It's more or less the same pattern. So when we look at the out of the money calls here and out of the money puts, you can see that there's more pressure on the very short-term options. This is 0.9 as opposed to 0.3, or 0.695 as opposed to 0.3. And here it's 1.1 as opposed to 0.2 on out of the money puts. So that's very, very focused on short-term options, the buying pressure there. And even more so for deep out of the money puts, 5.5. These aren't even significant. 2.3, well, it's not so clear for the directional. It's really clear, though, on the volatility trading that's very, very focused on the short-term options. And then when we look at the time zones, so this is using data from 2020 and 2021. Well, on the time of day effect, you can see that much less significance. European trading, very little directional effects, nothing in Europe on the direction. The most is from the US, and similarly on the volatility, the beta 3, 2.0 as opposed to 0.76, 1.85 as opposed to, and nothing in Europe on the volatility. So you can see that it's really the volatility and directional trading is really being driven by traders in those time zones, particularly. That's why I said at the beginning, I think we've got some big US TradFi hedge funds, and poor old Three Arrows was just one of these uninformed hedge funds that was lent a lot of money by Deribit, but then got liquidated. So this is just summarizing those results that I said, and these are the references. So, as I said, the US time zone trades on short-term options, most significant impact. The volatility motivated and directional motivated buying pressures are evident on out-of-the-money calls and puts, particularly in the US, but also directional trading driven by Asian traders, and particularly during the price bubble of 2021. That was very significant. The limits to arbitrage hypothesis that I spoke about, it now holds very, very well. So market makers are definitely managing their order imbalance and inventory more effectively. And the trading volume in derivative options has been pretty large, as I said at the beginning, since 2020. So these are the papers. The information one on options trade is in the Journal of Financial Markets, which will very soon be open access and freely available. This is in the Journal of Banking and Finance, and there's the reference to the Derman papers on those regimes. All right, so are there any questions? I've got a question from my daughter. Mum. Sorry, hang on, Helen, I've nearly finished. Oh, no, I was watching when you were in. Yeah, I'm in. Sorry. I'm recording. No. Okay, hang on. Oh, why is the trading volume on CME options so much less than it is on Deribit? Well, Deribit is self-regulated, so it's not, you can use whatever strategy you want. CME are very, very good at calling out any manipulative trades. Things like laddering and spoofing wouldn't happen on the CME, and also they close. So what are you going to do? If you've got an options positions and it crashes on a Sunday, obviously you want to trade on Deribit. Oh, I'm a natural. Thank you. Anyway, any other questions? You've got 2 minutes left for any last minute questions. Okay, well, I don't think there are. So thank you for your time. I hope you enjoyed the talk.